Hi, my name is Chris Sepper, and I want to welcome you to the MidAmerica Healthcare Venture Forum. It's our day 2 today of the National Investing Conference. It's based here in the Midwest and specifically in Chicago. We've been hearing from people about strategic investments, angel investing, venture capital, but we're also trying to talk about all aspects of investing and all the opportunities for entrepreneurs to find funding. So I'm here with Joe Hammer, who's a vice president at GE Capital Healthcare Financial Services, who focuses on life sciences and healthcare. And so, Joe, what I want to talk to you about is I want to talk about debt. That's something that obviously GE Capital does, but really what we were going to talk about here is a primer to empower entrepreneurs to understand what the new opportunities are and how debt has changed. So I'll let you take it from there.
Yeah, thanks, Chris. And I appreciate this opportunity. And as I was preparing for this, I spoke with 15 plus different people, everyone from VCs to intermediaries to other lenders. So I'm going to really give you a broad perspective. But debt for cash burning early stage healthcare companies has really evolved. It started out as a really equipment based, where you would have a certain percentage of equipment purchase, and then really with the transition of more virtual companies that had limited value, then it became more of a venture debt where you take a first lien on all assets, most likely carve out the intellectual property, which allowed lenders to provide more cash runway. And then you fast forward to today, lenders have been more collaborative than ever, really again focused on how to materially extend the cash runway so that the next equity round can be raised at a higher valuation.
A natural question that I've heard when I've talked debt with entrepreneurs, some of them say, will you do it pre-revenue? Will you do it, what kind of clinical data do you need? How much can I get, even if I'm a pre-revenue company that might be looking to do a phase 2 trial? Can you outline some of those parameters so people can understand a little bit about those amounts?
Yeah, it really comes down to what source of capital. Because like I say, there's a lot of sources of capital out there.
Mm-hmm.
I put it into 3 main categories.
Great.
So the first category is bank debt. And bank debt is going to come in earliest. So they'll probably come in preclinical to clinical. And then the second category is venture debt. Usually comes in after the safety profile is established. So probably at a CE mark, phase 2,
okay,
about the Series B. And then the final category that's really had a surge and an emergence over the last couple of years is structured finance. And they're going to come in usually post-revenue, certainly after there's been the clinical pathway has been de-risked.
Why has debt emerged as something more prominent in financing today for healthcare?
I think the number one factor, if you look, 10 years ago, there was much different equity environments. There's recently bio put out that from 2003 to 2013, the equity financing declined about 40%.
Mm-hmm.
So 10 years ago, where there might have been a stigma with having debt, it was very isolated to equipment. Today, you have an environment where venture capitalists and other institutional investors simply have less capital,
mm-hmm.
And you also have a very accommodating situation with a lot of private equity and other sources funding coming into the asset class. So it's really a combination of a couple factors that has made this option really grow quite a bit.
Well, and talk to, you mentioned 3 types, and I've been taking notes here: bank debt, venture debt, and structured debt. Let's do a quick overview of each one, because I think at this conference, we have early stage companies that are preclinical, looking for a kind of a phase 1 trial. You have some that have raised $15 million that are also looking for that bigger round. And obviously there's an array of companies out there just in the healthcare space. So talk about bank debt, what it was, what it's been, and address, kind of give people an overview so they'll know how to deal with it.
Yeah, so bank debt, like I say, it will be the earliest because they have the widest product offering. So they can come in as early as preclinical,
mm-hmm.
Usually from a size, start small, a couple 100,000, all the way up to about 10 million. And then for all 3 categories, I'll look at it as kind of an all-in cost of capital. So you can think of that as your upfront fees. So that could be 50 to 100 basis points, and then the coupon, which over the term, and then a final payment fee, and then you present value that back to today. And that all-in cost of capital for bank deals is really in the mid to high single digits.
Oh, okay.
Yeah.
So talk about venture debt.
So venture debt and bank debt blurs a little bit, but then venture debt really looks at deals anywhere from 5 million to as high as 20. We actually did a recent deal where that was 40 million, and that's focused again on the enterprise value and looking at what are the clinical milestones, evaluations coming up, and how do you match that with structure and everything else. So that's something that has really exploded over the last couple of years. And then the last category, structured finance. By my estimates, over the last 2 years, they raised about $5 billion plus, and they're looking at deals 20 million to about 100 million.
Wow.
They're looking at de-risk from a clinical perspective, and also they're looking at some revenues.
Well, I've seen that in some debt, I mean, people think debt, they think pay it back with interest. That's not the case with some debt. I mean, you'll wind up in some venture debt or later debt that you might give equity, or has that been a trend that's changed?
Yeah, so because we're lending to cash burning companies, that there is an equity participation, usually in the form of warrants.
Yeah.
With the competition and more lenders joining the space, that has actually come down. But so for the more competitive deals, great credits, warrants go away. For kind of the standard would be 3 to 7% warrants for on the bank or venture side. On the structured side, it can get north of 20, 30% of the overall loan.
Are there other things that, when you look at how these three lending sources have changed over the past few years, are there other attributes that you've noticed in that trend that we haven't touched on yet?
Absolutely. I think first and foremost, there's been a real surge of capital coming into the asset class that obviously needs to be deployed. So anecdotally, we looked at public information from most of the leading banks and venture debt lenders. And by our numbers, in 2014, there was about $2 billion of deals done, which was up about 53% over 2013 by volume. If you look at it by numbers of deals, that was up about, I think it was 34%, about 125 deals done. So you've got a lot more deals, a lot more capital coming into the asset class. And if you do the math on the average deal size in 2014, it's about 15 million. And that's also up about 16, 17%. So larger deals, improved terms. And really what I think that the silver lining here is it's ultimately much better for founders, for entrepreneurs. This is all non-dilutive capital. So this is, when you have the founders that are working their tail off trying to bring innovative technology to improve patients' lives by using non-dilutive cash, it allows them to hold on to it, and also allows the institutional investors to hold on to more of their company.
Well, I'd be interested in hearing, so you'd be competing, say, as an entrepreneur. I love that idea that I'd take a loan rather than I would take and give away equity, right? But so when you're competing, why do some people go for venture over debt? What are some of the pros and cons? You must hear common objections as you're going out. What are those, and how do those scenarios play out?
So just so I understand, so venture versus debt versus equity?
Debt versus equity.
Yeah. So
because I could imagine that if let's say it's NEA, right? NEA wants to come and put in $10 million into my company. Well, the name NEA means something. So, and if a bank puts that money in, that's nice, but having NEA behind me might be more meaningful. Is that a common objection, or are there other things when it's an equity competing against somebody who wants to take equity in a company?
Yeah, so I would look at debt and equity as complementary.
Okay.
And really, when we look at evaluating deals, especially on the bank side and the venture debt side, understanding that syndicate is really important. And understanding, so the way that we would quick look at it is, we have a management case of what are they projecting out. And again, all these companies are burning cash. So we'll stress that, and we'll figure out, okay, in scenarios A, B, and C, when do we think this company is going to run out of cash? And at that point, what liquidity options do they have? And the number one thing that we'll look at are the existing syndicate of equity investors. So what are the reserves? What is their investment thesis, and how is that going to be stressed? There's other liquidity options that we'll look at. So for example, there's been a surge in earlier stage pharma deals, a lot of time distribution deals for certain geographies. And that's really the core of any debt underwriting is what are the liquidity sources at what time and how much debt do you have outstanding. And that really just reinforces that this is a complementary vehicle to traditional VC institutional investing.
So you wouldn't see ever venture debt or beyond doing that alone. You're always looking for it as, all right, they've raised 10 million from a venture fund. We'll also do money. It's rarely all debt alone. Is that right?
Absolutely. Yeah. I mean, it starts to get a little bit more blurred when you get in the structured side because they're writing larger checks. So anywhere from 20 to 100 million. Over the last couple of months, you've seen a lot of $50 million deals. So those guys are far less dependent on the existing syndicate, although it's important to them. They're looking at data, revenues, and then the syndicate. If you have 2 out of 3, then you usually can get a structured deal done. Where on the venture and debt, on the venture and bank side, you definitely have to have confidence either in the existing syndicate or that through other clinical milestones or commercial milestones, it's going to be attractive paper for VCs or institutional investors.
That's an interesting trend because we hear about new entrants in the marketplace. There's new ways to get money, but for you, reputation of the other investors to the market seems to play a big sway in whether maybe they get that debt deal.
Absolutely. I mean, at the end of the day, we are investing in cash burning companies in substantial sums. I mean, $2 billion last year was invested in this vehicle. And the relationship, amongst the lender and the equity is paramount. And really what you're focused on is how are the parties going to react in a downside case? If everything is going well, everyone's making money.
Nobody's going to care. Yeah.
Relationship's great, but really what you want to focus on is what's going to happen in a downside case. And it's very specialized lending. From a lender's perspective, you have to have a portfolio. You have to be able to diversify your risk. So those relationships certainly build over time, and you depend on them because it's inevitable that what you start out with, those projections are going to change. Everyone knows it. That's a reason why, in the venture debt space, you're probably looking at all in of kind of low teens with equity participations, and on the structured side, it could be a cash in the high teens. So that there's inherent risk, and it's important that any lender is aligned not only with the management, the CEO, the founders, but also the existing syndicate.
I'd love for you to paint a couple scenarios. As I said before, we have many of the companies that were in the device diagnostic showcases. They've raised the first round. There were a few that had raised 15 million. Our online audience, obviously, we've got everybody from seed all the way into Series C and beyond. Let's talk venture debt and beyond. Is there a scenario for a company, maybe based on their clinical data or other things, that you would say this is a good candidate to try and chase venture debt? And is there a candidate that you've run into that tries to get venture debt and maybe isn't successful? Maybe a couple of mini case studies.
Sure. Yeah. So I think first and foremost on the bank and on the venture debt, it comes down to the equity investors. So you really want a strong syndicate that has liquidity. So that's kind of the first litmus test. And you also want to keep the overall debt to equity at about roughly 25%, right? So
25% of it debt?
Yeah. So you want to have roughly $3 of equity for every dollar of debt.
That's helpful.
So that's something that you need a certain amount of equity before you can start talking to venture debt. Banks might come in earlier again because they have more products to offer. For example, they can give you savings accounts, checkings accounts, that kind of stuff. Where it works extremely well is when you have a decent cash runway to where with the debt you're greater than 12 months. You have some inflection point within that term that's going to increase the valuation. So I think the true benefit of debt is to extend the cash runway. So if today the valuation is $1 a share, and then in 18 months there's going to be some commercial or clinical milestone where it's $1.50 a share. Debt is a vehicle that doesn't dilute the current shareholders or founders, and it gets you through that. If you're looking at it as a substitute for equity, that's not a good use.
Okay.
It's really looking at bridging you and extending the cash runway through an inflection point, so that there's less dilution to the investors and management.
Do you re-up? I mean, does a venture debt or any kind of debt wind up re-upping in a later round?
Absolutely. Personally, every time that you look for the amortization to start, and that's a key component of extending that cash runway. So on the bank deals, you might have up to 48-month terms. Venture, it goes up to 5 years. On the structured finance, it'll go 6 to 7 years. And a key component of extending that runway is how quickly do you have to start paying it back? So on the venture side, you can go 12 to 24 months with not paying interest back. And on the structured side, you can go as much as 5 years. So you have a 5-year bullet. And all of that is critically important to getting the company to a place that hopefully the valuation is higher, and at that point it works well for everyone involved.
We've only got a few minutes left, and I want to make sure I haven't left anything out that you think is important. Where do you see this kind of financing going in the future for healthcare, and are there anything else you want to add?
Yeah, I think that it's really, I'm bullish on this asset class, and I think you can just see by the macro trends that healthcare is a very dynamic place right now, and what this allows entrepreneurs to do is to really preserve that precious equity in the founders. And I think it also is another funding mechanism to ultimately bring patients to the market and improve lives. That is I think everyone's ultimate goal in this industry. It's something that differentiates us, and I think any option or any funding mechanism available to help that mantra and help that cause is positive. And I think it's only going to improve from an availability perspective. From a collaboration perspective, I think that is certainly very prominent now. As a lender, I approach boards and entrepreneurs collaboratively to figure out a structure that works well for them. And it's an exciting time for healthcare, and I think an exciting time for the asset class.
Well, you reminded me of one question I want to ask. VCs love talking about how many companies they see and how many they turn down. And, I've seen 837 companies and I funded 8, right?
Yeah.
What's your deal flow like? What's a realistic expectation when somebody says, I know I'm going to go and I'm going to chase debt? What's the success rate? How many people do you see? How many people do you actually fund?
Yeah, it's really,
generally speaking,
it's tough to generalize with that. I think ultimately in the space, it's described as venture-backed lending.
Yeah.
The VCs make the first cut,
okay.
And then I think from them, if our VCs are bullish on our technology, we will take a hard look at any of it.
Does it ever work the other way, where somebody comes to you, you think this is a great candidate, you walk it to a VC, or is it always the other way around?
It's always pretty much the other way around, because they really have the expertise.
Yep.
To go a little bit deeper on the science, and they also have the liquidity that we are inherently baking into our diligence.
Well, we're seeing the lights flicker on and off here. We're about to restart the main general session at the MidAmerica Healthcare Venture Forum. Joe, I really appreciate you talking about debt. It's kind of the final piece of all the different funding mechanisms we've been looking at here at the forum. And so on behalf of Joe, on behalf of myself and MedCity News, thank you for watching, and I hope you've enjoyed the coverage of the conference.
Thanks, Chris.